Have you ever wondered how private equity firms make millions, sometimes billions, and why everyone who works in finance seems to want to break into PE? The answer isn't just hard work. It's a specific formula that makes them millions. If we haven't met before, I'm Pietro, and I worked in investment banking for 3 years and corporate development for 7. So I've been on both sides of these types of transactions. In this video, I'm going to break down exactly what private equity is, how the money machine works, why leverage is their secret weapon, and how PE partners use the 2 and 20 rule to make themselves insanely wealthy. So let's dive in. Before we talk about the money, you need to understand what private equity firms actually do and why it's different than investing in public companies. Most people think that PE is investing in companies, but don't really understand that you can't go on to Robinhood and just buy shares in a private company. Privately held companies are ones that are owned by the entrepreneurs or fully owned by another private equity firm. And so the question is, why would anybody want to invest in private companies instead of public companies? Private equity firms buy privately held companies, which means that the business is probably owned by an entrepreneur or another private equity owned company. At the end of the day, here's the play for private equity firms. They will acquire a company with the intention to hold on to it for at least 5 years. Over those 5 years, they want to make the business better and then sell it to make a massive profit at the end of their investment period. Unlike public markets where information is available to everyone around the world and you're competing with the best investors in the world, the private markets are inefficient. And they're inefficient because there's just so much unknown with a private company. Back in the day, there were a lot of profitable businesses that were owned by either the entrepreneur or a family that didn't have an MBA or professional work experience. And private equity firms saw that there was an opportunity for them to acquire these businesses so that the owner can make millions of dollars. And once that business gets acquired, the private equity firm would put in their own professional management team with MBAs to professionalize the business, make it more efficient, and then after 5 years, the private equity firm would sell the business to another buyer and make a massive return. So at the end of the day, that's the core business model, which is buy the business, make it better over 5 years, and then sell it for more money than you bought it for. Here's where it gets really interesting and where private equity firms really make all of their massive returns. And they do it using a term called leverage. Think about it. If you need to triple your $1 billion investment, it's going to be really difficult for a $1 billion company to sell for $3 billion in 5 years. Most companies can't do that. So how do private equity firms consistently triple their investments in 5 years? There's a reason why there are banks all over the world willing to lend hundreds of millions of dollars to private equity firms for these types of deals. And the math really doesn't seem like it can make sense until you understand just one thing. Private equity firms use debt or leverage to buy companies, just like how you would take out a mortgage to buy a house. Private equity firms don't put down 100% of their own cash to buy businesses. They'll put down 20 to 30% and then take out debt to pay for the rest. Here's why this is genius. Let's say that a private equity firm has $1 billion total to invest. They could take that $1 billion and buy one company and then hope that in 5 years that business will be worth $3 billion. But it's nearly impossible to do. So instead what they do is they will divide up that billion and make multiple investments into smaller companies. Let's say that a private equity firm decides to buy a $500 million company with $100 million of their own money or 20% and then $400 million to finance the rest of the acquisition. If after 5 years, the business is worth $700 million or only 40% more, the private equity firm sells the business for $700 million and pays down the $400 million of debt that they have left. So that leaves $300 million left for them, or 3 times what their investment was. With only a 40% increase in the value of the business, the private equity firm was able to triple their investment in just over 5 years. And that's the magic of using leverage. leverage will amplify your returns. And so the more leverage that you use, the higher your potential returns are. But that knife cuts both ways. In the same example with the $500 million business, if in 5 years when they sell it, it's worth $300 million, well, the private equity firm still owes the 400 in debt. And so the equity investors will be underwater and facing lawsuits because they lost all of their investors' money. So you can lose everything if you take on too much debt. And so private equity firms understand that there is an opportunity to make significantly more by using more leverage, but you need to be careful and protect against your downside because that amplification can cut both ways and really hurt you if you take on too much debt. Leverage explains how they make good returns, but it doesn't explain why private equity partners are driving Ferraris and buying vacation houses in Aspen. That comes down to how they get paid. Private equity firms manage other people's money. So how do they end up making so much themselves? There's really two income streams that most people don't understand. One of them is steady income, but it's the other where real wealth gets created. And here's the controversial part, which is they pay way less in taxes than you would think. Private equity firms get paid through the 2 and 20 rule. And here's how it works. The 2 represents the 2% management fee for a private equity fund. So imagine that there is a $1 billion fund of investors' money. The private equity firm every year gets to charge 2% or $20 million so that they can just run the management of their business, so that they can cover salary, rent, operations for their firm of about 20 people, which is already great money. But it's the 20 that makes private equity partners really wealthy. And the 20 represents how carried interest is calculated. Typically, private equity firms need to return 3 times the initial investment of the fund entirely to investors. If after 5 years, that $1 billion funds that we were talking about is now worth $4 billion, the first $3 billion goes entirely to the limited partners or investors into the fund. But that extra $1 billion above is split 20% to the private equity firm and 80% to the investors. So out of that extra $1 billion, $200 million is now available for the private equity firm to split amongst the 20 people. And here's the really controversial part, which is that it gets taxed significantly less than what other high earners get taxed. Carried interest gets taxed at capital gains tax, which is about 20%, versus the ordinary income tax rate, which can get up to like 50% when you combine federal and state income taxes. That $200 million getting taxed at a significantly lower rate than what you normally would if you can make $200 million is why private equity is one of the most lucrative careers that you can possibly pursue. Okay, so we know how they make money, but how do private equity firms find companies to invest in the first place? It's not like you can just go on Google and search companies for sale. It's not like there is a central repository of entrepreneurs looking to sell their business. So how is it that you can even find high quality private companies that you can invest into? Private equity firms will typically find their opportunities through investment banks. Now, an investment bank is like an agent for entrepreneurs looking to sell their company. When you want to sell your company, you will hire an investment bank. The investment bank will tell you what they think that you can get for your company, and then they'll have relationships with potential buyers, just like a real estate agent. And so the bankers are always mining opportunities for potential companies that'll come to sale soon, and they'll keep relationships with private equity firms. So they're constantly showing PE firms potential opportunities for them to invest in. Most people who work in private equity originally started off in investment banking. Those relationships are invaluable. A lot of private equity firms still require their investors to go get an MBA. So the idea is that when you get an MBA, you're going to be networking with future business owners and have connections so that you can have an advantage when you're trying to find new opportunities to acquire. Now, when an opportunity comes in, The deal team will typically be split into a team of 3 to 4. So there will be a lead partner on the opportunity, maybe a principal, vice president, and an associate to run the analysis. Once the team runs the analysis, they're going to present it at the private equity firm's weekly investment committee, where the analysis needs to align with the firm's overall investment strategy, and the returns need to be in line with what the company thinks is necessary for them to make it a good investment. Now, here's what's critical, is that PE firms are obsessed with downside protection. Every single analysis needs to have a base case, a bull case, and a bear case, because private equity firms know that you can make significantly higher returns using leverage, but leverage works both ways. And so that could ruin a company if the investment goes south. So for every investment, an investor needs to ask themselves, if everything goes wrong in 5 years, where's our investment going to stand? And the way that a private equity firm answers that question is going to be what separates the good private equity investors from the ones that blow up. Now, we need to talk about the elephant in the room. PE has a bad reputation for acquiring companies and then laying off half of the workforce on day one. In the name of value creation, thousands of employees can lose their jobs overnight. And entrepreneurs who spent decades building their business see their most loyal employees looking for a job. So is this reputation deserved, or is the industry evolving? Here's the truth. In the early days of private equity, there were a lot of family-owned businesses that had employees on the payroll that really weren't earning their keep. They had an emotional connection with the owner, and the owner felt an obligation to take care of that employee. Private equity firms don't know those employees though, so they don't have the same obligation. All they see are numbers on a page. And so when a private equity firm acquired a company, one of the first places that they looked to create value was through staff reductions on the payroll. And so by making the business more efficient, then the theory was that you could then sell the business 5 years later and it would be more profitable, so you can make more money on your investment. But over time, what these firms are realizing is that when you come in on day one and lay off half the employee base, you are destroying morale for the other half of the employees that are still there. For those employees with low morale, they start to panic and then they leave to go take other jobs. And it takes forever to find good talent to replace the employees who left. Private equity partners are great at finance, but they are notoriously bad operators. And so starting off on the wrong foot by laying off half the workforce is not a great strategy if you're trying to create value over 5 years. Now, more collaborative PE firms are taking a softer approach to balance operations because you want to create value for the long term. It's a balancing act though, because you still want to create overall efficiency in the business, but you want to keep the core employees there who are the ones that made the business valuable in the first place. The industry is realizing now that downside protection isn't just in the form of financial analysis. It means protecting the employees that make businesses valuable in the first place. If you liked this video and want to learn about how companies other than private equity firms can buy other companies, check out this recent video about corporate development to learn another aspect of the high finance industry. Thank you for watching, and I'll see you next time.